Welcome to your commercial-free, uninterrupted investment show, sponsored by the SEC-registered investment firm, Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who has been putting clients' investment needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I am Brent Wilsey, president of Wilsey Asset Management, and with me is Chase. Chase, we got a lot to talk about today, don't we?
Always got a lot to talk about.
You know, and I want to talk about, I'm just wondering, I think it's becoming more of a well-known term. The opening, I think I wrote the opening, but I can't remember what it was. But something about how we do talk about a fiduciary firm. I'm just curious if more than 50% of people know now that fiduciary means we have to do what's best for the client, as opposed to the brokers have the suitability requirement, which means they don't have to do what's best for the client. They have to do a suitable investment. I'm just wondering if it's like 50% of people now know that, I wonder, or what?
I notice I get it. Even I talk to younger investors as well, and they bring up the fiduciary idea. I don't know if that's just from their parents, kind of make sure they're a fiduciary, but it is a more common question that we get nowadays. And we are 100% a fiduciary. We always talk about you have to be really careful of what we call hybrid advisors.
Yes.
Where they say, yes, we're a fiduciary, but hey, do you want to buy an annuity? That is not a true fiduciary, because you never know which hat they're wearing.
I don't think they say, hey, do you want to buy an annuity? They make it sound pretty good, where like, oh yeah, maybe I should get that annuity because I don't want market fluctuation. But yeah, down the road, 10 years, you'd probably do 2-3 times better investing than you would in annuity. But anyways, this is not a show about annuities. We are not fans at all of annuity. I don't think I've sold annuities since I first got into business, probably years ago. Probably maybe about 5 years, because at the time you're still kind of learning and like, oh, these annuities are good and so forth. And I realized, gosh, people I put into them didn't do that well over time. And then I started realizing, wait a minute, this equity investing, there's something to this. Warren Buffett does well at it. So does David Dreaman. So does Christopher Davis.
And it's kind of bad when you look at annuities and people bring them in and like, oh, that one was okay, I guess. I mean, but it's okay because the other ones are always so bad.
Right. And
it's still not good.
Right.
Like
right.
It's okay because the other stuff is generally so bad.
Right. And I think back when interest rates were high, I do believe I sold some annuities that did have a 8 to 10% yield on them. Well, I guess now I'm thinking that one if you get that today, maybe I would sell that one, but not at 2 or 3%. So
depends where the 10-year treasury's at. I think I'd rather buy a treasury if it's similar to an annuity.
Yeah, there you go. Yeah, because expenses on annuities pretty high. Anyways, let's talk about the stock market value index, because it's important to remember how quickly the right stocks can move. And it's one of the many reasons why I don't try to time market bottoms. If we look back to the last time the market was spooked by the Fed raising interest rates, it was December 2018, and the Russell 1000 Value Index lost 15.7% from November's close to the low in December. This is when we had an intraday bear market loss of at least 20% from the high.
Yeah, and then this is crazy how quickly things can move, and also too how quickly people forget about these things. Like 2018, I don't think a lot of people remember how tough this market was at the end of the year, but you just fast forward about 2 months to the end of February 2019, and the Russell 1000 Value Index gained 18.5% from the low and was about flat compared to the November 2018 close. With so much bad news currently being factored into the current stock prices, I believe the right companies can still end 2022 on a positive note. As always, when you think about where you will be 2 to 3 years down the road, it makes investing a lot easier. And you just can't try and predict the absolute bottom. There's no way to do it.
No,
I don't care who you are. I don't care what you're saying. Oh, I've done it once before. Yeah, but you probably try to predict the bottom 100 other times, and great, you're right 1% of the time, and you actually lost a lot of money on the other opportunities there as well.
I did see in the front of Wall Street Journal, I think it was yesterday, I was going to do a post on it. I didn't get around to it, but that Meta, Netflix are now, and I think it's the Value 1000 Index.
This one
right here. Yeah. And again, look where they fell from. I think Meta was a high of what? Did it hit 400? I think it was over 400, wasn't it?
I don't recall.
Yeah, you close. Netflix, I think, was over 600. Now they're both around the 150 to 175 range. I did not get a chance to look at the valuations to see how they look. but it could be one that I did not agree with. I believe GameStop went into the value index. Yeah, and it's just like, yeah, and it's like, really, I don't think they have any earnings, but that's what I mean. We get so busy at the office, I didn't get a chance to look at it. I think I still have the paper in my briefcase.
Yeah, because I saw the news on Netflix and Meta, and I did actually look at the valuations, and Meta now trades at, I hate saying Meta, Facebook now trades at under 15 times future earnings.
Yeah, and we like to buy around 10 to 12.
I'm sorry, it's 15 times trailing 12 months earnings.
Oh, okay.
Yeah, not the future earnings, because it was on my phone. I just pulled up the quick PE. It was 15 times trailing 12 months earnings. And then Netflix was trading at, I think it was about 16-ish times trailing 12 months earnings. So they could be around maybe 13-ish, depending on earnings growth, 13-ish times future earnings, which for having a huge index like that, I think you really could make the case. They are value companies now.
Yeah, and the thing with Meta, we kind of get off track here a little bit. Maybe somebody will call in on it, but is that they are kind of changing from social media, with their future being in the metaverse. Is that what that's called?
Yeah.
Yeah, and which is hard to understand. Could happen. But that's the thing that would worry me about, is that we don't, if it was just on the social media and stuff, like great, because I don't think social media is going away. Yeah. But how many billions of dollars will they be spending on the meta universe to be first in that one?
Yeah. And you know, I this might give my age away a little bit, but I think a lot of our listeners know I'm on the younger side. I'm about 30 years old. Right. But I was talking to, we do 401ks for clients, and I was talking to the guy that we were doing a presentation for. He's like, well, this must be really hard. And I'm like, we've seen it before. He's like, well, how many times have you actually seen it? You're pretty young, aren't you? I said, well, COVID was 2020.
Right.
And 28. And I just want to bring up the 2018 point, because of 2018, that was only a few years ago.
Right.
And it just, listeners can't see this. I'm just going right over my head right now. People forget about 2018. And remember, gosh, people were panicking. It was Christmas Eve. And it's like, gosh, what is happening in the stock market? It's terrible. And we're like, it's nothing to worry about.
Yeah.
Sure enough, as you said, that's why you just can't time it. The tide can turn so quickly, and we could be in the middle of a recession. Yeah, it's possible. I've been looking at the numbers, and I think potentially Q2 could actually lead to a recession. We've kind of had some disagreements on that.
Yeah. You had some good points, though, I will say.
Yeah, it's just because the inflation rate and GDP is based off real earnings, or excuse me, the real growth, which factors in inflation. Real spending hasn't been positive the last couple of months. So there could be cause to say, yeah, we could be in the middle of a recession right now. But the thing that people need to understand is the stock market is forward-looking. You could have a recession in the economy, and the stock market could rally over here because it's like, oh, we're coming out of the recession now.
Right.
That's why it's like, well, how's the stock market going up? Or the economic data is terrible. It's like, it's forward-looking. That's right. Why when all this bad news is already built into it, it just needs some good news to kind of rally going forward.
Yeah, and that's what they look at. It's like, how are the businesses doing? Just because you're in a recession doesn't mean that the businesses are going to do poorly, and it could be a short recession, temporary recession, where businesses do well, so the market just gets past it. Mm-hmm. I think what has kind of changed on yesterday was kind of surprised with the interest rates dropping, which I was kind of surprised, because I don't think the Federal Reserve is done yet raising rates. So I thought, well, this kind of sounds premature, but we'll see. We'll be watching it, but yeah, that's why we do what we do, and that's why we look at the companies and not the market so much. So speaking of tech stocks, with the markets falling, people keep asking me if they should hold and wait for their investments to come back. Had this conversation last night with a gentleman at dinner we had. I always say it depends on what you have, and it could be dangerous to hold the high-priced tech stocks we have talked about. If we look at the NASDAQ, which is a good barometer for many of the tech stocks, it is now down about 33.4%. Actually, I think because of yesterday, I think now it's down 29%. So it did recover yesterday from its 52-week high.
And I still would not be surprised if the NASDAQ fell 50% from its high, as valuations were just out of control before the recent sell-off. If this fall did occur, that would be a fall of another about 25-ish%, we'll call it, from current levels. It's important that we don't forget history, and that in the tech bust, the NASDAQ fell close to 80% from its highs. So if that were to happen again, it would be a decline of 70% from today's levels. This is one of the main reasons I stick to value investing, as people forget how risky these high-priced tech stocks can be, and they could go back up. But But the thing is, the valuations still don't justify where a lot of these tech stocks are trading. So I don't want to take that risk because we know that things can still fall tremendously based off history. Things are still expensive. So you want to avoid those. And the value stocks, they could go down just with the rest of the market, of course, but they come back much faster many times because you don't have this valuation risk. It's like, wait a minute, this company's trading at 10 times earnings, where a lot of these tech stocks, they could be trading at 30 times earnings, and now they're trading at 20 times earnings, and it's like, well, wait a minute, that's still expensive.
Still expensive, yeah. That's the thing that people will miss, or investors will miss, is that they see that and think, oh, compared to the 30, 20 is cheap, but compared to the average history of the market, no, that is not cheap, and it could go cheaper, especially what we talk about, and I think we did this last week about Apple, where Apple has $400 billion of revenue. They want to have growth. Well, 10% growth in that revenue would be $40 billion. Where's that going to come from? And if they can't do a 10% growth, and for whatever reason they only come in making $20 billion, well, it's only 5% growth. The growth investors say, oh, it's over for them, and they start dumping it. This is how a growth stock can become a value stock.
Netflix and Meta.
Exactly. I was going to say the same thing. So again, Apple, Microsoft, great businesses. But everything eventually comes back to the mean. Will it happen tomorrow, next week, next month, next year? You don't know. But that's the thing. And that's how Warren Buffett, I was watching a video from him on his investing. That's how he's done well for so long. Not by getting into the high flyers. And yes, he did buy Apple. He bought it, I think we bought it around the same time he did. The difference is we sold it. He did not sell it. But I think if he were to sell it now, he'd be in trouble because I think he owns, 20% of the company? Some huge amount. Yeah. And he would actually cause that stock price to dive. But he's done some other great value investing. But now with Apple, it's just kind of like, I almost feel he's stuck with it. But he could start unloading a little bit. I don't know. We'll see what he does. And then we always talk about, too, we don't think he's the only one calling the shots or doing the investments any longer.
Yeah, and it's a great point, too, about the growth stocks is we've now seen a couple earnings reports from companies. We saw a home builder. We saw FedEx report the other day. And those reports have actually been better than I think feared. So a few of those stocks have rallied quite nicely. Now, earnings, we're ending Q2 here next week. What's that? Yeah, because the first is, I believe, next Friday.
Yeah.
So the end of Q2 will be next Thursday, and companies will start, like the banks are going to start reporting probably about second, third-ish week of July. It's going to be very interesting because I think the earnings could either be catalysts for companies to rally, or they could be cause for concern for these companies, and it could make some companies dive much quicker. So I'm, again, coming back to this idea of I don't want to have these high valuation stocks because, as you said, if it's like, oh, they grew earnings at 8%, but the market's looking for 12%, that stock could dive very, very quick.
Yeah, and that's why a value company, we're expecting 4% growth. Oh, they did 5%, stock pops.
Yeah.
So let's talk about the United States supply chain because Morgan Stanley conducted a survey of more than 400 executives from large corporations in the U.S., Germany, and Japan. They discovered the most important factors in supply chain decisions are geopolitical stability, skilled labor, physical infrastructure, and a developed supply chain ecosystem.
And unfortunately, happy to share here that the United States outranked Europe, China, and Mexico in many of those areas there. The good news is 18% of the companies plan to significantly expand U.S. manufacturing in the next 12 months, and 36% have a 3-year plan for doing the same. I also observed that more than 40% of the U.S. companies are working hard to onshore supply chains. This could be a big benefit in our economy over the next 12 to 36 months. Again, we're talking about potentially some companies maybe slowing down hiring. We've heard more news about companies rescinding job offers, maybe actually having some layoffs. We've heard that from some bigger tech companies in particular. The manufacturing sector, perhaps, if we do onshore more jobs, could be a big benefit there.
Yeah, and that's so important, too. I want to bring up, because people are really kind of down, like, the administration, the border, now it's the abortion, Roe versus Wade. I mean, there's so many negatives out there. But you step back, and I've said this before many times about our country. We have our problems, but there's not a country better in the world. Also, too, we talk about the physical infrastructure. I mean, we've got roads going all over the place. You go to some of these third world countries, it's hard to transport goods because there's not a road to kind of get there. Or if it is a road, it's a bumpy, dirty bumpy road that you know, got potholes, your truck breaks down and so forth. So we have a lot of things. We have a legal system that is a pain in the butt sometimes, but also too, we have a legal system so you're not so concerned about doing business with someone and being concerned that, hey, they're going to screw me over, I have no recourse. You know, so we have our problems in the country. We've always had problems. I mean, that's part of, I think, of a democracy. But we do have a lot of good things. And we said here about the executives and so forth, we have a great place to still do business, even though, and again, I complain all the time about the permits, the regulations, the taxes and so forth, but we still can do business.
Yeah, I still do business, and it is just one thing, too, that kind of going back to this whole recession concern and this bear market, and this is why we buy businesses.
Right.
It's because these companies aren't just like, oh my gosh, my business is over, we're in a recession, I guess I should just give up. Yeah, no, they look at, okay, what are we going to do now? How can we make our business more efficient? What are we going to do to improve the supply chain? How are these investments that we're making today going to help the business 3, 5, 10 years down the road, not tomorrow, next week? But again, it's that longer term. And these businesses, again, they're not worried about the issues that are at hand in the short term. They're trying to resolve their company and make it strong in the long term.
Yeah, and also too, just remember that, and I remember when I was younger, my parents complained like, oh, it's never been so bad. You had the Kent State killings on the campus there in what was Ohio. All the negative, oh, this is terrible, and oh, this is terrible, not terrible country, but things are so bad here now. They're always bad because why? The media, I think, always brings out the bad stuff, which it does happen. But if you didn't know about it, we'll still get through all this. And that's why investing in value companies is what we like, because we're not playing the hype game, but we know that the country will make it through this situation because we've been through this before.
Sometimes I wish I could go back in time and just see, like, pre-media, what was society like? Did it panic about stuff as much? And then, when the radio came out.
Right.
And then when TV came out. And now you have the ultimate magnifier of that with social media, where everybody's posting about how terrible things are.
Yeah. It's like, oh my gosh, I'm so depressed because of all this. But there are good things to look at. That's what we try to do. And again, you don't want to be unaware of it, but you want to say, okay, what is this really going to do? It's not going to destroy the country. So if you like the information that we give out here on the radio show, it is part of our newsletter that we pull out the highlights from our newsletter. That goes out Friday afternoon, I believe. If you want that free newsletter with this information we talked about and more, go to our website, smartinvesting2000.com. That is smartinvesting2000.com for the topics we just talked about, and even more so to help make you a smarter investor. Also, we got our quarterly workshop coming up on Thursday, July 21st at 6 o'clock in Scripps Ranch. This is a time that you want to hold on to the fundamentals. This is when it's so important to say, what am I doing? What do I have here? And that's why we show you everything we do at our firm that I've done for many, many, many years, how we do it, how it got me through, the banking crisis in the 90s, got me through the tech boom and bust, got me through the Great Recession, the COVID situation. It will get me through this situation, other situations as well. We share all that with you. We show you how to look at the fundamentals, look at the financial statements, and also how to come up with target buy prices, sell prices, and everything else. It is a free workshop, but you have to sign up for it. Go to our website, smartinvesting2000.com. That is smartinvesting2000.com. And Chase, I just realized I forgot to give the phone numbers, so we got nobody waiting for a call here. Let me give out the phone numbers for that unbiased, no strings attached, fundamental opinion about what you want to talk about. Call 833-288-0973. That's 833-288-0973. And I thought this would be a great time to kind of go back to our emails that we get, because we do get behind on those. We always take the calls first. Let me go this one here. Says, maybe a question for the radio show, or if you just want to answer it. Does a increasing interest rate make for a good buy of either Visa or MasterCard or even Discover? So I guess we got a choice of 3 to look at fundamentally, or just want to ask a question.
It's interesting because I know Discover, the valuations are quite nice, and it's funny. I actually just canceled my Discover credit card yesterday.
Why'd you cancel it? What happened?
I had too many credit cards, so consolidating down, and the service there with Discover was great. I just didn't use the credit card anymore. So, but I believe that they actually kind of hold the assets a little more, where Visa and MasterCard, they obviously just do the swipe essentially, and that's how they get paid. So I believe the valuations for Discover have always looked quite appealing, but I'm almost more interested in Visa and MasterCard at this time, because I'm curious how they've held up so far this year, and perhaps they were expensive as heck last year. I'm wondering if now with a pullback.
Yeah, and I pulled up the fundamentals on Visa because I do want to kind of look at that, and also too, I'm in the midst of, I pulled out the data on it. I haven't done it yet about consumer credits like credit cards, like Synchrony, like Capital One, and so forth. And actually, Discovery had the best pay ratio as far as people not defaulting. I believe there's one I didn't hear of. It's another big one. But they had the worst, like 4% or something. So, but I will try to get that. It's on top of my desk about with 4 or 5 other things, but I'll try to get that done. Let's take a look at Visa, though, because I am kind of curious myself here. They are in the credit services. Their symbol is V for Visa. Only 2% float, so not a lot of short on there. 97% institutional owned. PE ratio 32.3 versus 16.9. Price of sales also high, 16.5 versus 4.5. No price to tangible book value versus 50 for the industry. And price of cash was expensive, 27.6 versus 14.3. And they do have a good PEG ratio, 1.6 versus 2.9. Now, looking at their earnings, we do see over the past year, their earnings did climb by 31.6%. Not as good as the industry at 47.4, but still growing earnings at 31%. Pretty attractive. And their sales were up 26.1% versus 23.1. They do have a 5-year growth rate of 18.1% versus the industry at 18.4. They pay a dividend of 0.7%, and that's pretty low. But I am surprised because I expected to see a much lower payout ratio, but that payout ratio is 22%. Not high, but for 0.7, I thought it'd be like, 0.10 or something. I thought it'd be much lower. We do see that they have paid that dividend for 10 plus years. Look at the balance sheet. We got a current ratio of 1.3, same as the industry. Good debt to equity, 0.6 versus 1.4. Their profit margin, and we don't have time for this, but I would love to check out how they get a 51.1% profit margin versus 26.8 for the industry. Return on equity very high, 38.3 versus 41.9. Just unbelievable numbers here on the profit margin, return on equity. And I know this is why I think a couple of years ago Congress came after them because of this, and they fixed it, went around it.
Well, that's kind of the interesting thing is, we've kind of seen that Congress is kind of looking at now, or I forget the regulatory
CPBD or something like that.
Yeah, the
Consumer Protection Board.
Yeah, they're going after kind of the financial companies that charge late fees.
Yeah, including credit cards. Yeah.
But that's not Visa and MasterCard.
They're included in that.
They are?
They are, yeah.
Okay. I thought it was more the banks that held the receivables that charged late fees. I didn't think Visa and MasterCard, because Visa and MasterCard, like you go to, I have a couple of Visa MasterCard cards, right. But you go to Citi and JP Morgan Chase and Synchrony, they're the ones that charge late fees. So Visa and MasterCard, I think they kind of escape a lot of the regulatory concern, but the problem is I think Congress has gotten on them for it's like, what are you even doing for a 55% margin?
And again, I haven't written the post yet on it, but I do remember seeing that Visa and MasterCard were on that list. But you're right. I believe the banks are the one that collect those fees. So I'll have to do more research on that, write the post so we get the details correct. But you're right. What are they doing to make all this money?
Because I believe they just get percentage of the swipe fee, essentially. Yeah. Because they're not holding, that's why their balance sheet looks so much different than banks. They're not holding the receivables. They're not holding the loans, so to speak. And I haven't looked at Visa or MasterCard's 10Q, 10K because it's always been so expensive, but I believe that's how they make money. I don't know if there's any other way they make money, but that's one thing I would want to know.
And it is a great way. Every time somebody swipes that card, they make, and that's why you see the merchant fees of, I think, 2 to 3%, depending on the card. That is quite a bit to make. So the more people swipe, they do better. And the banks make the money, I think you could be right, off the late fees and also the interest, which, you and I both say never, ever carry a balance on a credit card. But, that's where the banks make the money off it.
Yeah, so it is something that is interesting. I mean, it's a great business model. I think it's very low risk essentially, but generally, I'm kind of surprised by the numbers here because with recession concerns, that's generally a slowdown in spending, which would impact obviously the amount of times people are using their credit cards.
Right.
So I would think the stock would be struggling, but it's actually held up quite well.
And I think part of that reason, I know I want to give the numbers as well, but I think part of the reason is too is that during a recession you can use your credit card more because you don't have the cash to pay for it. So unfortunately, you'll swipe your card maybe more, and then the banks get benefits because you can't pay off the card. So, but yeah.
Yeah. So with that said, I mean, it's definitely a lot of kind of conceptual ideas here that you'd have to understand with these credit card companies. But current price here is $205.51. It has pulled back from its 52-week high of $252.67. The low here, $185.91. And I say it's held up well because it's only down about 4.8% year to date when the S&P is still down about 17%. And especially I thought this company with the valuations you mentioned would have been dinged a little bit harder by the rising interest rates. But going forward for the business, I go out to September 2023. Looks like they report on a fiscal year. I see estimated earnings per share of $8.42 would give us a target sell price here of $139.77. I mean, it still trades at a forward PE of about 24 times. I do see that the growth on this company, I mean, this year, 2022, they're looking at growth of 21.4%. Next year, 2023, 17.3%. I mean, very good double-digit growth for this business. Where is it coming from?
Right.
I mean, are people really using their credit cards that much more? Are they increasing their fees on the credit card? I mean, I don't know. I don't know how they're increasing earnings that quickly.
You know, one thing that I saw this past week, I read, I think it was in the Journal, that people, because of their gas, they're not putting $100 in. Instead of going once and put $100 in, they'll go 2 or 3 times and put $40 or $50 in. Now, but every time you swipe your credit card, they get paid. But actually, percentage-wise, it would still be the same. So that would not help them on the transactions. And I do see here, and our numbers are a little bit different, but I do see here over 90 days ago, the estimates were 848. They did fall to 837. So the estimates are falling over the last 90 days. Not a lot. But they do say that credit cards are somewhat recession-proof because you still use your credit card, but you may not swipe it as much or use it as much because, again, once you swipe it, they'll get that 2 to 3% fee, but the bank then benefits if you carry the balance.
Yeah, and the problem, though, is with a company trading at, we'll call it 25 times future earnings, if it slows down, and still increasing, but at a slower rate, as we were talking about earlier, I think the stock could get hit. So I kind of want to answer, I guess, there's Johnny's question about rising interest rates. To be honest, rising interest rates I don't think is going to have any impact on Visa and MasterCard in particular. It would have an impact on Discover because, again, I believe they hold those receivables and charge on the loans and so forth. But these are more, I'm going to say, dependent on the economy and the frequency of credit card transactions. So that is a interesting business. I love Visa and MasterCard. I know they're very well-known names just from that aspect, but I just have never looked at the business because the last, I'd say probably, 7 years, it's just been too expensive.
And we don't own these companies, so we don't really follow them that closely, but I do wonder, like with this type of company, what could be the thing that would change business? Is it the Venmos to where you're not going to use the credit cards? Is it the PayPals? I mean, there's other things that will take away business from the credit card companies. That's what I always wonder when I own a business, like, who's the competition? What could take away my business there? So, and I don't know if it'd be a Venmo or PayPal. I know they're growing quite a bit, but and I have seen when I sometimes go, you see PayPal, but it goes through Visa anyways, which is kind of strange. So,
yeah, I mean, Visa and MasterCard have a very good stronghold on this business.
Yep. Phone numbers, all lines are open, 833-288-0973. That's 833-288-0973. Let's go back to our email questions here. I would like your opinion on a stock investment. I am aware of significant financial issues I believe recently resolved with the SEC. The company name View Incorporated, ticker VIEW. That's from Ed. So let's take a look at View here. I don't even recognize this company. Do you recognize it, Chase?
No, I'm kind of pulling up a little bit ahead of time here, but it is a little bit smaller. It's only $414 million market cap. So that could be one reason why we haven't heard of it.
Yeah. Okay. Well, let's take a view here. Again, their symbol is VIEW. They're in the industry of building products and equipment. We do see no short on the stock, which is you very rarely see that. Institutional ownership 81%. No PE ratio versus the industry at 14.3. So that's not a good start. Tells me over the last 12 months, no earnings there. Price of sales looks high, though, 4.4 versus 1.3. What does look good is price to tangible book value, 0.9 versus 17. So it tells me you're paying 90 cents on the dollar for the tangible assets of the company. No price of cash flow, no PEG ratio either. Could be not much on here because, as you said, it's a smaller company. I see no earnings growth over the last year. Sales growth up 107% versus 17.6%. They do not pay a dividend. Take a look at the balance sheet here. Current ratio 3.3 versus 1.9, so it's a positive for the company, a lot of liquidity. Debt to equity is 0.1 versus 0.6. We do see net profit margin problem here, a negative 463% versus a positive 8.7. Return on equity, a negative 71 versus 18.3. So it seems to be they've had some big write-offs or something in the past. What do you have going forward, Chase?
Yeah, well, to start here, this company is interesting. And I know you talked about it's a building equipment company or construction company, essentially, but it's also a technology company, according to the summary, because what it is, it's smart windows. They use like artificial intelligence to automatically adjust in response to the sun and increase access to natural light to improve people's health and experience in buildings, while simultaneously reducing energy consumption to mitigate the effects of climate change.
Did you say this company does that kind? No, Corning was actually looking at something similar to this. Is this a company that just installs it? They actually came up with this concept.
You know, I
can't tell from
I can't tell from the description. Yeah. It looks like they do that technology, so I think they have the window, but maybe they use an outside glass provider like a Corning. So obviously, many times, like a company like Apple, they make the smartphone, but they have so many other components that they utilize. So that could be the case. Also, one warning popped up here that's always very concerning, and this might be what Ed's talking about, is there was a late filing with the financial statements with the SEC. That is always something that greatly concerns me. Why are your filings
Why are you late?
Yeah.
You know it's coming up.
Yeah, so that's something, it sounds like Ed may have addressed that in the email, but always you want to understand what the heck happened there, because that could be a very, very big danger. Looking at the current price here, though, for View, it's $1.89. Wow, look at this 52-week high, $8.79. And the 52-week low, gosh, this stock is all over the place, 37 cents.
Wow.
Very, very volatile. Year-to-date return down about 51.7%. But, gosh, within the last year, to go from $8.79 to 37 cents, that is a huge change.
Yeah.
So, I mean, it's a very... I'd say very risky stock. And unfortunately, I can't give a target sell price because I go forward to December 2023. It looks like just one analyst, not surprised being a small company, but that one analyst does have a estimate of negative 65 cents. So no earnings on the company yet. I do think it's potentially a good trend that could occur with the smart windows and, saving money on electricity bills and, helping the climate, so to speak. That's a big hot button right now, but it's just not what we do here with the valuations, not pointing to strength. And anytime a company has issues with the SEC, I got to say be careful.
Yeah, and sometimes you kind of look into that to see what's going on. But there's not really an incentive to do that because there's no earnings, going forward for the company. You've got, no return on equity. You did have a good price to tangible book value, but it's just there's too much risk on this to say, you know what, this is worth doing all the research, because this would take a lot of research. You really have to kind of look back at the financial statements. Why are they late? What is going on? Is there something that's wrong here? And then you have to kind of determine, okay, is the SEC right here? Are they wrong? They're going to stay on top of this. Are they going to come after the company? It is a small company, but still, this could force that company to bankruptcy, and you lose everything invested. Mm-hmm. So that's the thing there. So Ed, I personally don't think it's worth the research, but I mean, you could buy it at $1.89, and they could turn things around. It'll be at $8 2 years from now. But high risk, high
Could
reward.
also be $1.89 and go to 37 cents like it did already.
Go to
or
zero.
Yeah.
Right.
I don't. It looks like they had a good enough balance sheet though, where they could last for, gosh, I don't know, a few years.
Yeah, and sometimes that is a problem to where it's like a slow bleed.
Yeah.
And you hold it, nothing happens. That's where it's so important to do your research to say, is there some positive catalyst I can find here that could perhaps turn this around? But that takes a lot of reading, a lot of, interpreting of what's going on. And right now, especially at this time of the market, and with the market where it is, there's now other good buys out there. Why spend so much time on something that may not pan out for you? So, all right, all lines are open, 833-288-0973. That's 833-288-0973. And as always, that'll get you through for your unbiased, no strings attached, fundamental opinion about what you want to talk about. But right now, we're going to talk to our financial planner, Harrison Johnson. Good morning, Harrison. How you doing this morning?
Good morning, guys. I'm doing well. How are you doing?
Well, I'm doing really good because I like this topic here, deducting California taxes for business owner. Being a business owner, I like subjects like this. So explain what you're talking about here.
So in 2018, there was a lot of tax changes, and some of those changes limited itemized deductions for individuals. So one of the examples of that is the SALT tax. SALT tax stands for state income taxes and property taxes, and those taxes were limited at $10,000 that was able to be deductible. Now, for states like California, it's not uncommon for your state income taxes and property taxes to be $20,000, $30,000, $40,000 a year or more when those are added together. So this was a piece that limited tax deductibility for high tax states like California and New York, things like that. However, there's a new California law that is going to come in and help business owners of pass-through entities. So in this case, an entity that is taxed as a partnership or an S-corp, which could be a general partnership, a limited partnership, an LLC, and an S-corp, all could qualify. And basically what this is going to do is it's going to allow business owners to, instead of paying their state income taxes on the individual level and itemizing them like normal, what it's going to allow them to do is pay those state income taxes through their business and then treat them as a business expense, which is going to reduce their federal tax liability. So that's exactly what the SALT did. The SALT was a deduction, so it reduced your taxable income. Now, this would allow business owners to have a direct reduction of their AGI, which still gives them that federal tax deduction and could have some more benefits by reducing their AGI. So this is something that business owners definitely need to be aware of. And also, you have to be aware, if you are a sole proprietor, you do not qualify for this. It has to be a pass-through entity. So if you have a sole proprietorship, it might make sense to look at converting that over to an LLC or an S-corp or something like that, so that you can get this advantage and begin deducting your state income taxes.
And here's this another good reason why, again, I have a good financial planner that knows these different things as well, because you see somebody's making big money as a sole proprietor, like, gosh, you should be better off as a sub-S corporation or pass-through or a LLC. But that's why, again, you sit down, you talk to people. And I've seen you go in your office, and sometimes you're in there for, 90 minutes, 2 hours, going all these different things for people. But you got to know what's going on, things like this. And I'm so excited and this came from the state of California or from the IRS?
Gavin Newsom signed it.
Really?
Yeah, this is something that Gavin Newsom did, yeah.
They must have slipped that in there, and he didn't realize when he was signing. He's never good at businesses. So. But hopefully he doesn't realize it and take it away from us.
Is it?
Yeah.
So
yeah, well,
is it only for pass-through income that you can deduct it? Because obviously a lot of times as a sub-S corporation, you have your W-2 and you have your pass-through income. Is the tax that you can deduct for both, or is it just the pass-through income?
It's just the pass-through income, yeah. And so it has to be a pass-through entity. So, in the past, I've always kind of liked S-corps over like a sole proprietor anyway, just because you avoid some of the Social Security, Medicare taxes. But there hasn't always been a huge difference in tax liability. Now this is a new piece, which is really going to add a lot of savings for business owners.
Yeah, and just something that can finally help a little bit on that side. But, well, Harrison, thank you very much. I know it's a Saturday, a beautiful Saturday out there. So you have a good Saturday, and we'll see you on Monday.
All right. Thanks, guys. We'll see you Monday.
Okay. Bye-bye. Again, that's Harrison Johnson, our certified financial planner. He is on a salary. He does not sell any commissionable products. He does not, try to, sell you anything at all. It really is a financial planner. You sit down and talk about your situation. He looks at what else is better for you for financial plan. It's fee-based planning. If you want that free consultation, a couple ways you can do it. Go to our website, smartinvesting2000.com. That's smartinvesting2000.com. Send him a message. You can call him directly at the office. Speak to him that way. 858-546-4306. That's 858-546-4306. And I do want to mention it's going to be here before you know it. Our workshop on July 21st, 6 o'clock in Scripps Ranch. It is a free workshop. We talk about how to actually invest. And also, too, now is when people may be making the wrong decisions that you shouldn't be making. Maybe, well, I won't go into them. We'll go into the workshop. But there's things that you shouldn't be doing now. We go over what you should be doing and also what you should not be doing. We do come up with target sell prices. We come up with, the target buy prices. We come up with why you should stay on track. We show you all these important things to make you a smarter investor. It is a free workshop, but you have to sign up for it. Go to our website, 858, call the office, 858-546-4306. That's 858-546-4306. Speak with Priscilla. But you can go to the website, smartinvesting2000.com. That's smartinvesting2000.com. Very easy to get the website. Right up in the right-hand middle side of the page, you'll see workshop registration. Click on that. Get you signed up pretty easily.
And I think it's so important that we do these workshops, especially in times like this, because it reminds me of that quote from Mike Tyson, the boxer, that everybody has a plan until you get punched in the face. And paraphrase that, I don't know if I nailed it exactly word for word, but something along those lines.
I think it's pretty close.
Yeah. But that's the whole thing, is a lot of people, when things are easy investing, say, yeah, I got a great investment plan, and they think they have a plan. But all of a sudden, now you start to hit this where, I know people that are down 30, 40% on their portfolios because they took such big risks.
Yep.
Well, what's your plan now? They don't have one because they got punched in the face.
Right.
That's why our investment plan, it's worked now. Value investing has been around for over 100 years. Mm-hmm. And it gets you through these tough times. And this is when it is so important to have a good plan of how you're going to invest in tough times like this.
Yeah, and we show you what that plan is and why it does work and so forth. So, again, been doing it many times. I've been doing that workshop, I think, for well over 20 years, and it's not going to change 20 years from now, but we do it once a quarter now. So this one is going to be, again, July 21st, 6 p.m. in Scripps Ranch. And we just love doing them. We like talking to the people and stuff, and people say. So, all right, phone numbers here, 833-288-0973. That's 833-288-0973. Let's go to San Diego and speak with Jim. Jim, you're on the Smart Invest Show. Brent and Chase, how can we help you?
Hi, Brent and Chase. I'd like to know what you think about Amcor Technology, or how the numbers look, please.
Okay, do you hold that, Jim, or looking to buy it?
I have a few shares, yeah.
Right. Well, let's take a look at Amcor Technology. Their symbol is AMKR. They own the industry of semiconductors. The float on this, short-wise, is about 8.9%. We do see institutional ownership is not that high. It's 39.6%. We see a PE ratio, very good PE ratio here, 6.1 versus 18. Good price to sales, 0.7 versus 4.4. Price to tangible book value, 1.4 versus over 100 for the industry. And then price to cash flow checks in at 3.8 versus 12.1, and a very good PEG ratio, which is your price earnings divided by the growth, is 0.3 versus 4.2. So the valuation ratios look very good on Amcor Technology. We do see the earnings over the last year were up 74%, beating the industry up 56%. Sales climbed 22.7%. That is also above the industry at 13.9%. I see a 5-year earnings per share growth rate of 21.4%, also above the industry at 16.8%. They pay a dividend of 1.2% and only use 6.3% earnings paid out, which tells me they could increase that dividend if they wanted to. We do see on the balance sheet, current ratio 1.8 versus 3.1. That's okay. Debt to equity 0.5 versus 0.6. That's a good debt to equity. Net profit margin 10.8. I believe this is the first number where the industry has looked better, coming in at 25.4. And return on equity is 22.4 versus 27.1. Chase, are you going to spoil my happy party here with something going forward not good or what?
Well, to start, I mean, I think we talked about it last week about semiconductors, but I think now with the pullback in all of these semiconductor stocks, I think you can start really picking out some strong ones because we know semiconductors are not going away.
Right.
And we know, in fact, they're probably going to continue to grow in demand. So I think this is a great opportunity to find the right ones. Now, at Amcor, let's take a closer look at these numbers here. Current price here, $17.29. 52-week high, $29.50, and the low, $16.26. It's down about 30% year-to-date. You know, the technology sector and also chips have kind of struggled to start the year, so not surprised that it's down. I am surprised by this, though. It is about a $4.2 billion market cap. I've never heard of this company, so I thought it might be a little bit smaller, but it's decent size. The problem is there's only one analyst following it, providing an estimate for earnings per share go out to December 2023, though. I see it's $2.95. With $2.95, we would get a target sell price here of $48.97. I mean, the valuation on that one estimate looks very good, but many times we like to see more analysts than just one. And it is somewhat concerning, I guess, but it could be potentially a positive. As you said, the institutional ownership is very low.
Yeah.
I'm wondering what this company needs to do to start to get involved more with the institutions, because then you get more analysts following it and likely increase the institutional ownership, which could be a catalyst for growth as well.
Yeah, the market cap of $4.4 billion is not that small, so I am surprised one analyst was surprised on the institutional ownership. One thing that does worry me about this company, we always tell people to be very careful of here, Jim, is that you want to make sure that they don't have like just one or two big customers. And that's perhaps where maybe you don't have the analysts like, oh, this is just a one-trick pony. So some more research would be needed here to find out why they only have one analyst. Do they have just one big contract or two big contracts with one company? I think it's worth the research a little bit. Because I like the numbers. The numbers all look good, but...
Yes, that's what I was thinking, that like you said, a lot of things have been beaten down, and I thought this might be a good opportunity for this one.
Yeah, so I would really, look at the last probably quarterly report, see what's going on there, how they did for the quarter. I think they're on a calendar quarter, so that'll be coming up probably another 6 to 8 weeks probably, how that's going to go. But I think it's worth the research, and it's not a tiny company. Are you seeing something, Chase?
I was just kind of curious on their customers. I just looked that up real quick, and I was wondering about this because they aren't a fabrication company. Right. They do testing services and outsource that and packaging. So it looks like their customers, they have major customers including Intel, Philips, Sony, Toshiba, Agilent. So there's a bunch of different places or companies that they sell to. I'm curious what the breakdown is, though, of the revenue. You'd hate if, let's say, Intel's like 60% of that or something, just throwing out a number there. That's not what it is, but something to look at.
Yeah.
All right. Thank you very much.
You're welcome, Jim. Thanks for calling. Have a good one.
You too. Bye-bye.
Bye-bye. All right. That does open the phone line, 833-288-0973. That's 833-288-0973, and a very slow day on the calls today. So let's go back to our emails, kind of getting these caught up here. Now, where is the question here? What's your opinion on nuclear energy, specifically the stock as well?
It's in the subject line.
The subject line is CCJ.
I believe that's what
that's it. That's what you got? Okay, well, let's take a look at that. And we've not seen anything with nuclear energy, and I know it seems to be becoming more of what do I want to say? Okay or accepted, I guess, nuclear energy.
Well, especially with the energy crisis we're going through, I think people are looking for alternatives, and done right, nuclear can be a positive to the environment and to the energy source.
And I think I got the right company here under CCJ. It's Cameco.
Yeah, that's what I pulled up as well.
Because I do see it's in the industry of uranium. I don't think we've ever looked at a company with the industry of uranium, so this will be very interesting. 66.5% institutional owned. No PE ratio. Price to sales very expensive, 7.3 versus 3.6. Price to book value looks good though, 2.4 versus 5.7. That is price to tangible book value. Price to cash flow is 19.8 versus 19.1. PEG ratio 2.7 versus 13.7. Now over the past year and 5 years, I see nothing for the earnings growth. On the sales over the past year, it's down 9.3%. Industry was down 7.2%, and even 5 years down 8.1%. Whole industry down 14.7%. But this is very interesting here. The 5-year estimated growth estimate from the analysts is for looking for 56.9% for the company versus 28.6%. They do pay a small, very small dividend, 0.4%, no payout ratio because they have no earnings. Very important here is the balance sheet. Very good balance sheet. Current ratio 5.1 versus 13.1 for the industry. A lot of liquidity. Debt to equity only 0.2 versus 0.3. Net profit margin a negative 3.6 versus a positive 9.5. Return on equity is also a negative 1.2 versus a positive 0.8. Wondering if they got earnings going forward.
Yeah, so current price here to start, though, for Cameco, again, ticker symbol here is CCJ. Well, it's $22.50. I see the 52-week high was $32.49 and 52-week low $15.34. So, again, another volatile stock here that's really kind of been all over the place to start the year or over the last year. I do see year-to-date up 3.2%, which is positive considering where a lot of the market is at currently. Again, as a reminder, the S&P is still down about 17% year to date. Good size company though, and I say good size, about $9 billion market cap.
Good size.
So it's a good size company, as I said. Go out to December 2023, estimated earnings per share 82 cents would give us a target sell price of $13.61. So, I mean, you see earnings growth here of about 342% because it was negative last year. It looks like they're looking for 19 cents this year. And I said 82 cents next year. They have about 11 analysts, which is a decent number there. I'd feel okay with that. But the only problem is the low is 21 cents and the high, well, that's $1.99.
Yeah.
So it's, I think, a very questionable industry right now. People aren't quite sure what direction it's going to head. I say questionable more in that regard, not so much of like an ethics issue, but more so of how common is nuclear energy going to be? Is this going to be a path that we're interested in pursuing? Obviously, if it's a path that we are interested in pursuing,
right,
the stock will go up.
Right.
But if it's not, the stock will go down.
And it's very hard. I mean, because I've not read much on this because it's just not, for years it wasn't a big deal. I think now it's coming back in because now alternative energy sources, and I believe nuclear is probably one of the most dependable compared to wind and solar because nuclear is always going to produce, where wind you need wind and solar you need sun. So I think we could see more of this in the future. I would not feel comfortable yet investing in the company because you said the big range of those estimates. And also, too, I do have in the back of my mind, I still remember those protests and no nukes and all this other stuff. Have they fixed those problems, or if we have another meltdown again, like we had with Chernobyl in Russia, and the 3 Mile Island was another one that I remember in my history here, that happens again, these companies will get slammed. Yeah. But I would love to see it, come to where there is no risk to them, because that would be a phenomenal way to get through an energy situation.
And they say, again, not an expert on this field, but they say it's clean energy. It can be very scalable in terms of how much it can produce, where, that's a big issue with solar and wind is you can put all these farms, but in terms of the electric grid, it's still not going to help that much yet.
Yeah. Those are more like an assistance to the electric grid, but nuclear could really run the electric grid. But I also do wonder too about nuclear waste. That was another thing too, that you had this waste, where does that go?
And I mean, there is nuclear energy right now as well. It's not like this is a new concept. It's just a concept of maybe we expand that use. And I was trying to see if I could find electric grid? Because I know we have looked at like how, coal still fuels the electric grid, and I forget how much nuclear is of it, but I wanted to say it was like it was close to like 20%. So it wasn't
Really? That sounds high to me.
I thought it was pretty high.
I know, like San Onofre up the street here, up the road, that one's shut down. They don't operate that. So I'm not even sure which ones operate. And we haven't really looked at this. And I pretty much, look at the Wall Street Journal every day. We listen to a lot of business news and so forth. It's not talked much about at all at this point in time. I mean, every once in a while it comes up, but nothing major yet to where you're hearing anything. I mean, so.
Yeah.
Anything?
Still kind of looking.
Still looking.
Nuclear was 18.9% of the electric grid in 2021.
That is a surprise to me. I didn't think it would be even close to that. I thought maybe at best maybe 10%, but wow, almost 20%. That is a surprise.
Fossil fuels 60.8%, with coal being 22% of that, natural gas being 38%, nuclear was 18.9%, and then you have your renewables at 20%. Which includes wind at 9%, hydropower at 6%, solar at 2.8%.
I think you're over 100%. Did I miss some numbers here, or did I get something?
No. So fossil fuels includes natural gas and coal.
Oh, okay. Because I was thinking, like, wait, we want to leave 100%. So that fossil fuels includes, you said, gas and coal. Mm-hmm. And of that, how much does it have a breakdown of how much was coal?
And then coal was 22%.
Okay.
Natural gas was 38%. Your total fossil fuels is 60%.
Right.
The nuclear is 18.9%. Your renewables, which includes things like wind, hydropower, solar, your renewables total is about 20%.
So actually nuclear and your solar, wind energy is about the same.
Yeah, and I was surprised here, too, that hydropower is higher than solar.
Oh, hydropower is water. Mm-hmm. I forgot about that one. So that's higher than solar. How much was that?
Hydropower is 6.3%, and solar is only 2.8%.
I guess the problem with hydropower, you got to be close to the ocean to get that done.
Yeah.
Or I don't think they can use it in streams or anything, or lakes, or.
I'm not sure.
Yeah. So. Very, 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 and this is kind of like the conversation we have in the office when we're talking about investing, is we try to figure out all these different things, try to understand what's going on with different topics here. But it's just kind of interesting. And when I come down to it, though, I think it's still too early to invest in nuclear. Yeah. I like the concept. We gave the numbers. I still believe that your fossil fuels are here for still, I'll say, many years
decades.
To come. Yeah, decades to come, because it's the easiest to get. Natural gas is good. So you've got things there that it's just so hard to change. And I'm not against the environment, but also too, I mean, when you look back now, they have a lot of things now, scrubbers and everything else. And I do remember, actually, I think we read this a couple of years ago about how a big polluter are your ocean liners, because they have no regulations at all, and they just spew out this dirty sulfur and everything else. Yeah. So, well, one thing I did want to talk about too, we got about a minute here, is I did want to talk about investing. The reason I don't like rule of thumb is many times they don't work because parameters have changed. Take the example of a safe investment of 60% in stocks and 40% in bonds. According to Bespoke Investment Group, year to date, that philosophy has produced a negative return of 18%.
Yeah, and you go all the way back to 1976. That's how long it takes to find a return that low. And again, this is why we always tell people to perform well in investing, you have to analyze all the parameters and look at what's going to perform well going forward. And again, we've talked about not being in bonds. Well, bonds are still doing terribly, and we still think bonds are going to do terrible going forward as we continue to think rates are not done rising.
Yep. There's the closing bell. Wow, that was loud today. Thank you for listening to the Smart Investing Show. It is for informational purposes only and should not be used as investment advice. If you'd like to discuss in more detail your investment needs, have other investment questions, feel free to call myself, Brent Wilsey, or Chase Wilsey at 858-546-4306. That's 858-546-4306. And visit our website, smartinvesting2000.com. That's smartinvesting2000.com. You can sign up for the workshop coming up on July 21st at 6 p.m. and also that newsletter as well. Thank you for listening to the Smart Investing Show. We'll talk more next week right here. Have a good day.
So amusing to think that I did all that. And may I say,